So, who really controls your wallet? You might think it's the president or maybe Congress. Well, the real answer is a bit more complicated. Turns out, the single most powerful economic tool in the entire country, the power to basically set the price of money itself, isn't held by anyone you can actually vote for. Nope, it's in the hands of a small group of experts in this place people sometimes call the fourth branch of government. And that leads to a huge question, a real question of power. What happens if a president just doesn't agree with the folks setting interest rates? Can they just fire them, clean house and bring in their own people? This isn't just some academic thought experiment. It gets right to the heart of who runs our economy. And like I said, this is not theoretical. It's happening right now. As we speak, in January 2026, the Supreme Court is literally deciding a case, Trump versus Cook, that is going to answer this exact question. And trust me, the result could fundamentally change the balance of economic power in the U.S. for decades. So to really get what's on the line here, we've got to pull back the curtain on this very mysterious institution. Okay, so to make sense of this whole court case, you first have to understand what this fourth branch even is. We're talking about the Federal Reserve, or the Fed. And look, this is not your typical government agency. It was built from the ground up to be different, to be walled off from the messy day-to-day drama of politics. So let's rewind a bit. Congress put the Fed together way back in 1913. Why? Because the country had just been rocked by a bunch of absolutely brutal financial panics. The goal was pretty simple, really. Just create a financial system that doesn't collapse all the time. But the way they did it, that was radical. They decided to give a ton of power to a group of economists and technocrats, and then build a giant wall around them. A wall designed to keep out politicians who, might be tempted to pump up the economy right before an election for some quick votes. And how they built this wall is actually pretty genius. First off, Fed governors, they're appointed for a whopping 14-year term. 14 years. That means one president can't just come in and replace everyone. But here's the real kicker. The Fed funds itself. It makes money from its own investments. Congress can't hold its budget hostage, you see? This financial and political independence, it's baked right into its DNA. All right, so who are these people? These unelected officials pulling the levers of our economic machine. Now, this is where things can get a little murky. A lot of myths and, frankly, conspiracy theories tend to pop up. So let's just clear the air on that, shall we? I'm sure you've heard this one before, right? The idea that the Fed is some secret private corporation owned by giant banks like JP Morgan. And, okay, here's the thing. It's technically true that private banks have to own stock in their local Federal Reserve Bank, but that ownership is, well, it's basically meaningless. They get a tiny fixed dividend, and they have almost zero say in the decisions that actually matter. It's not like being a shareholder in Apple. And this right here, this table perfectly shows you that firewall in action. Just look at the board of a regional Fed bank. See the 3 classes of directors? Okay, so the Class A directors, those are the ones who actually represent the private banks. But look, they are legally banned from the single most important job, picking the bank's president. And that president is one of the people who helps set interest rates. That crucial decision is left to the other directors, the Class B and C folks, who were chosen to represent you and me, the public. So where is the real power? It's right here, with a group called the Federal Open Market Committee, the FOMC. These are the people who actually vote on whether to raise or lower interest rates. The committee is made up of 12 people, the 7 governors in D.C. who are appointed by the president, plus the president of the New York Fed, and then 4 other regional bank presidents who rotate in and out. It's a whole system designed to get both a national and a local perspective. Okay, so we know who they are, but how? How does a committee of just 12 people hit the brakes on a massive $25 trillion economy? Well, the way they do it has completely changed since the 2008 financial crisis. All right, stick with me here. Imagine the entire banking system is a giant bathtub, and it's filled with money. We call that reserves. Before 2008, the Fed kept the water level pretty low. They'd add or drain just a little bit of water every day to get the level exactly right. But after the 2008 crisis, they basically turned on the fire hose and flooded the tub. So now the tub is overflowing with money. Taking out a single cup of water, it does nothing. So they had to change their whole strategy. Instead of trying to control the amount of money, they now control the price of it by setting a floor. This new approach is called a floor system, and it really comes down to 2 main tools. First, there's the rate the Fed pays big banks just to park their cash with them overnight. Think about it. Why would a bank lend money to someone else for, say, 3% if they can get 3.5% risk-free from the Fed? They wouldn't. So that rate becomes the floor. And then they have a second, slightly lower rate for other types of financial firms, and that just helps make sure everybody's rates stay right where the Fed wants them. Now, as you can probably imagine, having this much power has led to some absolutely epic fights over the years. See, presidents almost always want lower interest rates. It makes borrowing cheaper, it juices the economy, and it looks really good right before an election. The Fed, on the other hand, often has to be the grown-up in the room, the one who takes away the punch ball just as the party's getting good. So, after basically being forced to print money to fund World War II, the Fed finally won its modern independence in 1951. But that didn't stop the brawls. You had President Lyndon Johnson literally shoving his Fed chair against a wall, screaming at him for low rates. Then there was Nixon, who successfully bullied his chair into pumping up the economy before his re-election, which directly led to the runaway inflation of the 70s. And that memory, that ghost of political interference, haunts the Fed to this day. It all came to a head in the early 80s with the legendary Paul Volcker. In an act of what I can only describe as insane political courage, he hiked interest rates up to 20%. 20%. It caused a brutal recession, but it broke the back of inflation. And in doing so, he restored the Fed's credibility and established a powerful, unwritten rule. Presidents, you don't mess with the Fed. I mean, just listen to this quote from LBJ. It perfectly captures the raw emotional pressure these Fed chairs are under. It really is a constant battle between what's good for a politician right now and what's good for the economy in the long run. And that brings us right back to where we started, January 2026. Because that unwritten rule, that norm of presidents staying out of the Fed's business, it's dead. And the fight has moved from a shouting match in the Oval Office to a legal battle at the steps of the Supreme Court. So here's the legal showdown, right? In one corner, you've got the president's lawyers. They're arguing something called the unitary executive theory. It's this very broad, muscular view of presidential power that basically says the president has to have control over everyone in the executive branch. They're saying that the legal requirement to fire a Fed governor for cause is a really low bar, something they can easily clear. But in the other corner, Governor Cook's team is firing back. They're saying, no way. Congress intentionally built this fortress. For cause means actual misconduct, not some trumped-up charge just because the president doesn't like your policies. They argue that if you take away that protection, the Fed's independence is just a meaningless phrase on a piece of paper. And you have to remember, this whole legal battle isn't happening in some sterile courtroom. It's playing out in the real world, on an economic knife's edge. And the numbers, they really tell the story. Okay, first up, inflation. It's running at 2.7%. Now, that is way, way down from where it was, but it's still stuck above the Fed's 2% goal, and this is exactly why the Fed is refusing to cut rates, despite all the pressure from the White House. But at the same time, look at unemployment, 4.4%. I mean, that's still pretty low historically, but it has been creeping up, and that's a warning light on the dashboard. It means the Fed's high rates are starting to slow down the job market. And this, folks, is the classic painful dilemma the Fed always faces. Do you fight inflation, or do you protect jobs? It's no secret which one the White House wants them to pick. And this right here, this is the weapon at the center of the whole fight. The Fed's main interest rate is at 3.65%. Now, in the language of the Fed, that is firmly in restrictive territory. That means it's not just tapping the brakes, it's actively trying to slow the economy down. And that single number is the source of all this friction. It's what this entire political and legal war is all about. But here's the thing, even if the Fed wins the Supreme Court case, there's an even bigger, darker cloud on the horizon. It's a concept called fiscal dominance. With the U.S. national debt as high as it is, the government has to pay a mind-boggling amount in interest every year. And the real fear is that someday the Fed might be pressured or even forced to keep interest rates low, not because it's good for the economy, but just so the government can afford to pay its bills. And if that happens, well, that's the end of Fed independence. Game over. So it all leaves us with this incredible paradox, doesn't it? We've handed over this immense power to a group of unelected experts, basically because we don't trust the politicians we do elect to manage the economy for the long haul. So what is it? Is the Fed a brilliant, necessary check on political short-sightedness, or is it an undemocratic fourth branch that's accountable to no one? The Supreme Court is about to give us one answer to that question, but the debate itself, yeah, that's not going away anytime soon.